Hello everyone and welcome back. My name is Greg Furman, a market analyst here at TraderPlanet.com, and these are the market positions for November the 29th, 2011. Now, to get started, our first position tonight is going to be in the US ETF market, the spiders, the SPY. Now, what we're looking at is a corrective move higher in an effort for us to set our short positions. Now, with the equity markets, I don't believe we're going to have any sustainable rally. So the spiders normally follow the S&P 500, but they're lagging slightly behind. So what I anticipate is that the SPY will move a little bit higher, and then it'll sell off aggressively. So we can identify our key levels here: 121.56, 119.89, and 118.52 with a close of 119.71. So our key level still resides at 121.56. We can see that right now our short-term crossover from Vantage Point is attempting to cross to the upside, barely doing that. Medium and long term are still saying down. Predicted short, medium, and long term, the predicted medium and long term difference is clearly oversold, so we want to let this work itself off a little bit, push a little bit higher, and we're going to use that to set our short positions. Now, predicted MACD, predicted TSI, also fully supportive of a continuation to the downside. We then come into our daily report. Looking at the daily report from Vantage Point, we can see 120.21, 118.95. That's our range for tomorrow. That's what we're going to play. That's a pretty decent move here. So any move towards this 120.21 area, we're going to use that to set our shorts. And of course our stops would be above the 121.36 area, above that 18-day predicted moving average from Vantage Point. Now, when we pull up our predicted high and predicted low, we look to see how accurate the Vantage Point software has been. We can see it's been quite good. There's been some volatility though. It's either breaking the top side or it's breaking the downside. For the last several trading days, it's broken the Vantage Point predicted low, only to reverse today and break the predicted high. But we may have broke the predicted high, but the trend has not changed here. So we're going to use this short-term volatility to allow it to push the market higher so we can get a better price on our shorts. So in theory, your aggressive traders, they're going to go in at the recommended entry around the 120.36. Your less aggressive traders want to hold out for closer towards that 121 area. That's fine too, but use the opportunity towards the 121.36 area to set those short positions. Now, that's our first position for tonight. Our second position is going to be a very similar trade. It's going to be in the January light sweet crude oil futures contracts. Now this one here, again, you don't want to do both of these trades at the same time because the correlation is very high. We've had a push higher today on the crude oil contracts, which I've talked about in the Forex Weekly Outlook, that it's clearly following the S&P 500. We anticipated this corrective move in the S&P 500, and it may continue a little bit further, just over that 1200 mark, before the next wave of selling comes in. So we're going to use this opportunity to get into the short positions. Predicted MACD, predicted TSI crossing over the trigger in heavily overbought territory. Predicted medium and long-term differences staying below that zero line at trend-ready levels. Predicted short-term difference here has pushed above the zero line, but it's a very short-term indicator. When we look at our crossovers here, our short-term is crossed back to the upside. We can anticipate a move back up. The medium-term crossover remains to the downside, and the long-term crossover flat with a downward bias. So from there, we go into our daily report from Vantage Point, and let's have a look and see what's going on. Now, again, we're going to have a very choppy, volatile markets, but we want to use this to our advantage. 119 is the predicted high for tomorrow. We're going to use anywhere close to this area to set our short positions. Stops always based around percentage of account. I have to be careful what I say there, but stops in my opinion should be over the 103, 104 area, the previous highs in the spike on those candles. Now again, when we look at and we talk about ranges, the ranges here on crude oil, they come in right around this $100 mark, and then again down around the 95. We can identify that this is not a range up here. These two candles are two daily candles, and they were caused by economic data. I believe at the time it was a lower inventory reading, weekly reading on crude oil. So we can see that the spike higher above the current range, which sits at 100, was immediately followed by a downward candle, and the primary trend then continued to move lower, and it really hasn't recovered much from that. But again, this is not how you would identify a range by these two candles, because again, one straight up, one straight down. The primary range is right below it, where we can identify 3 attempts to break through that $100 mark, which it couldn't do, only for it to break it, then immediately to retreat below it. So again, when we're looking at this, everything points that the crude oil will follow the equity markets. So when the equities start to turn back down to the downside, which I suspect will be midweek, we're going to we may get a little push over the 1200 mark, but there's going to be a lot of sellers waiting up there, and when those sellers come in to sell the S&P 500, the same people will come in and hammer crude oil contracts back down to the downside. So with that said, these are the market positions for November the 29th, 2011. And again, my name is Greg Furman, market analyst here at TraderPlanet.com.